Good afternoon, everyone. I want to thank you for joining us here today for a quick webinar and update on the U.S. equity markets. I'm joined here today with Eugene Yashin. My name is Steve Tuttle. We're both portfolio managers and partners here at Krasny Financial. And some quick disclosures are popping up on the screen right now, so if you can quickly glance over those. Today we're gonna cover again U.S. equity markets, a fairly quick overview of where we are and our outlook looking forward. We're going to cover size and style, an update on recent performance, and again our outlook. We're going to cover our multi-factor models and what they're telling us right now about the U.S. equity markets, and we're going to cover some particular attention on the value style, which is working quite well right now. And then we're going to sum up the equity individual stock portfolio models that we have in terms of what's working, what's not, and some recent changes that occurred in our portfolios as part of our rebalancing. So to start off, I'm going to cover some high-level economic indicators that we track here. And there's several factors that we think have an impact on our overall equity allocation. So in terms of the indicators that we are watching closely right now, market volatility is fairly low. Treasury yields are low but rising. So in terms of history, yields are low, but just over the last few months, they've risen quite a bit. The yield spread, which is the difference between longer-term bonds and treasuries and shorter-term treasuries, that's within a typical range. Both the low treasury yields and the average yield spread to us bode well for equity markets. Inflation, still very low, again showing some signs of increasing recently, driven in part by rising energy prices. But overall still low. And then economic expansion. The U.S. economy is growing. It is fairly healthy, although the growth is perhaps a little bit slower than we'd like. So in terms of what conclusions we can draw from these indicators, it sure looks to us like the fundamentals are improving. The U.S. economy is, as I said, still growing and is showing some resiliency. The election results, market is clearly interpreting those as pro-growth for the economy and for corporate earnings. In terms of risks, which is of course important and something that I spend a lot of my time on, looking at what can go wrong. Valuations on the U.S. stock markets overall, the broad markets are a little bit on the high end. There's still a lot of geopolitical risks out in the global economy. With the new administration that we see coming in, there's some uncertainty in terms of what exactly they will be able to implement. And then rising bond yields, as we mentioned, over the last 2 months, they've shot up fairly quickly and fairly aggressively. So if we look back over the past year, and then in the near term, the most recent 3-month period of time, value is outperforming growth. Small caps are outperforming large caps. And Eugene will talk a little bit more about both of those dynamics.
Right.
Eugene, you want to take it away?
Thank you, Steve. So as you see on our next slide, well, we usually show this slide at our update. This slide shows the 12-month rolling averages, differences between the value side of the market and the growth side of the market. And as you can see there, it's very cyclical. There are cycles, and right now we've entered the cycle where value is outperforming growth, and everything above the red line is when value was dominant, and below the red line is when growth was dominant. So we before maybe 7, 8, 9 months ago, we were still in a neutral territory, and now we clearly entered value area. And usually, once we we have a regime shift like that, the value style regime or growth style usually lasts between 1 and 3. In terms of size, you are looking here at the monthly return differences between small and large, and that's the blue line, and then you have the sub groups, the small value, large value, that's the brown line, and small growth, large growth, that's the green line. You can see that over the last several months, we see small caps in all categories starting dominating the large caps. But before that, there was a pretty long 2.5 years of large caps outperforming small caps. So that trend, usually the size cycles are longer and last on average between 3 and 6 years. So if this small cap trend becomes more sustainable, we can expect a prolonged, pretty long period of small caps dominating the marketplace. On this slide, we actually look at the, some of the indicators, macro indicators, factors Steve touched upon before. This is our own, proprietary analytical system we'll look at. So as you can see, the blue line is the BAA credit spread, and the yellow line is the yield curve slope. And the yield curve, is a difference between 10 and 2-year Treasury yield. So you can see that while the credit spreads are going down, which is very bullish, we see that the yield curve slope is perking up, which is also a bullish sign. So we, at our last webinar, devoted to stocks, we talked about our comprehensive macro analysis framework, where we'll look at 68 different macro factors and, the stock market and the bond market indicators. And we come up with the forecasts for different economic sectors and the overall market movements. And what we found out that we can, with a pretty high probability forecast over the following 12 to 18 months, which sectors would be probably would have a higher probability of outperforming the broader market. So per our analysis, you can see that we are overweighting financials, industrials, materials, and telecom right now. At least, that those 4 sectors come out as pretty favorable. Then we have neutral posture in consumer discretionary, technology, and healthcare. And we underweight utilities, energy, consumer staples, and real estate. On the next slide, we actually show the dynamics, how that forecast, and this forecast is a 12-month in the future, right? So in November 2015, that forecast predicted what would pan out over the next following 12 months. So you can see how consumer staples, for example, we're going from being pretty favorable to turning a little, red here, so becoming less favorable. And on the opposite side, for example, industrials, they were not so hot a year ago, but now we see, and the forecast tells us that they should do well over the next following 12 months. So you can see that consumer discretionary we talked about, consumer staples don't look that attractive. Energy has been improving recently, and with OPEC getting those output cuts, we believe that energy is going to stabilize. Financials look good. Real estate is kind of iffy for now. Healthcare kind of deteriorated a little bit, but we believe that if there is a change in political, posturing towards healthcare, we might see a reverse there. Industrials have been improving, especially right now with new administration. We do expect getting some infrastructure projects going, so we will probably see more improvement in the industrial area more. So then we will have the technology. Technology has been kind of weakish, but there are pockets of technology, semiconductors, software producers, which is still pretty, fundamentally attractive. And it has been improving a little bit. Materials, a year ago were not as attractive. We expect materials to be much more attractive. I guess they passed the the lowest point, so we expect materials to do pretty well in this inter-expansion period. Telecom has been pretty favorable and still looks pretty strong, and utilities kind of look out of favor at the moment. So there, again, we're trying to cover the major themes in the marketplace. So one of the biggest developments recently was the domination of value over the next couple of months, and the presidential election triggered a much larger re-rating and kind of emphasized the trend, which started flickering through a few months ago. So we do expect value, as we talked about, to really dominate over a few months, and that value will be represented by more financials, energy, industrials, rather than the traditional value plays such as consumer staples or utilities. Margins and globalization. We see the new administration, very pro-growth, but at the same time, there are potential risks of trade wars or some sort of retaliation towards some of the international trading partners. So we do see some risk, which is pretty remote right now, but it still exists for some of the industries which really enjoyed and thrived on globalization and really enjoyed the resources, the cheaper labor they could get to overseas, and that includes some of the IT companies, some of the industrials, some of the consumer discretionary. But all in all, that's just the area we're watching. But at this juncture, we don't see the signs of which would overly concern us. Consumers are still flush with cash. The recent, employment numbers point to a tighter labor market. So we do expect consumers and the wage inflation. So we expect consumers still being pretty cash rich at the moment. The next slide is really important. That slide actually shows the dynamics and the progression as we go over the last few years of different, fundamental factors we look at. We have our proprietary score, which is a long-term score. We do have here a few value factors, price to earnings, price to books, price to sales, price to earnings to growth. Those are very traditional, value factors. We have some growth factors, the consensus next 3 to 5 year earnings growth expectations, 5-year sales growth expectations, the operation margin, return on equity, return on assets, those more of a quality and profitability group. And then we also have the safety factors, the safety rank and an unadjusted beta. So what we show here is the difference in performance of the best two quantiles, or the first 40%, versus the rest of the marketplace, judged by each individual factor. So we take the cheapest 40% companies, but judged by price to earnings, and we find the median performance, and then we compare that performance to the universe average. And as you can see right now, we've got all the value factors turning green. So they start working again. But before that, they were kind of rosy to red. So they didn't really work over several quarters when the market was really concerned about the geopolitical issues and the U.S. economy dragged into recession by China, and so on and so forth. Now all these fears kind of slowly are dissipating. So we see the shift from safety, which was really strong over a very long period of time, which is very unusual, towards value. And what we learned from the past, usually those spells of value dominance are followed by growth dominance, and our GARPA framework really shines during those times. So we do expect the shift in the efficiency of our score as well. In terms of if we kind of look at our portfolios and look at what worked and what didn't work year to date, we almost through the major part of the year. We can say that financials worked for us with, regional Western banks. We've got good exposure there. They started re-rating in November of the presidential election. There are a few things which moved those companies. The energy is stabilizing, consumers are getting healthier, the expectations of some of loosened regulations, which should help the whole sector. All those things helped financials to re-rate, and we kind of benefited from that. Healthcare, again, we were positioned for the most part of the year with reduced or reshuffled healthcare, with less exposure to pharma and biotech and more exposure to instruments and healthcare services, which played well in our favor. Consumer discretionary, again, we're looking at positions which would benefit from the tighter labor market, and we still hope that the wage inflation and household formation will contribute to some of the pockets of consumer discretionary we have in the portfolio. And IT semiconductors played a really big role in our portfolio, and we see that trend continuing in the future. And with regards to detractors, energy was very speculative over the bigger part of 2016. So now it's stabilizing, and we expect energy to really improve going into 2017. Industrials, again, because of the exposure to energy, we're a pretty uncertain sector now. With aerospace and defense, probably would benefit from the budget, increased military budgets, and the same going for the stable energy. That part will contribute to industrials going forward. Consumer staples we don't expect to improve, and that's why we're actually reducing our exposure to the sector in our all equity portfolio. And software, as I said, IT might be threatened a little bit by some of the geopolitical developments. We will see if that pans out, but we're watching this area pretty closely. Right now, this slide shows that the changes in our strategic all equity portfolio which we just implemented. And you can see that overall, we increased the smaller caps presence in the portfolio. We further tilted towards value to capitalize on the value trend. And we are overweighting financials and industrials. And we're revising the exposure in healthcare, making it a little more in line with the marketplace. The broader posturing by sector, you can see that financials occupy the larger place in the portfolio, followed by information technology, consumer discretionary. Those are more in line with the marketplace. We have healthcare in line with the market. Industrials are overweight, consumer staples are underweight, and materials are overweight. The changes in our strategic dividend equity portfolio really didn't change the overall posture that much. Our dividend equity portfolio is much more large cap oriented, much more value oriented. We invest in companies in this portfolio which pay higher dividends, so they're by definition much more value oriented. And then in terms of sectors, we try to align our strategies with the macro themes we're expecting to work out. So we're overweighting industrials and materials, and we're increasing financial, strategic dividend equity portfolio. And in terms of the posturing, again, because of the dividend, we are bumping and having pretty sizable presence in financials, energy, industrials, healthcare, consumer, discretionary. And we just reduced utilities, but in comparison to broader market, this sector is well represented as well, just because of utilities paying pretty substantial dividends. And we've introduced real estate as a bigger portion of the portfolio. Real estate used to be a part of financials not so long ago, but then at the end of August, it got carved out. So we have a pretty sizable presence in real estate as well.
Thank you, Eugene. That was excellent. So again, Eugene and I are available to speak, answer any questions you might have, either on the information that was presented here today or anything affecting your portfolios. We're always available. Our emails are on the screen right now, and you can always call our office number and ask to speak to us. We'd be happy to discuss your situation with you. So again, thank you very much, Eugene. Great job as usual. I look forward to speaking with many of you in the future, and thank you again for your time.
Thank you so much.